The IPO process, the IPO system, is a rigged game designed to fleece everyday investors, investors just like you, to take money out of your pockets and put it into the pockets of Wall Street insiders. Just look at the Airbnb IPO, up 115% from its listing price. Doordash, up 86% from its listing price. C3AI, or AI stock, that IPO, up 138% from its listing price through this IPO process. The IPO process is broken. It is designed to fleece Main Street everyday investors and give it to the Wall Street insiders. And this video is to go over why this happens, what's a potentially better solution that you're starting to see in some other companies, actually two different solutions, and some of my thoughts on it, and why this happens, and how potentially you could try to avoid this. So first, a quick plug. This is Unrivaled Investing. My name's Daniel. This is a no-hype financial channel, mission focused on finding you exceptional companies and unrivaled investments. If you enjoy looking for potential multi-baggers, make sure you subscribe. If you're already a subscriber, I appreciate that thumbs up. And if you want to follow my personal journey to try to find potential multi-baggers, go to unrivaledinvesting.com, click on Journey. So let's go back into this rigged IPO process. So how does the IPO process work? And why is this process so problematic? So you can see here, this is generally how this process works. It starts with some sort of bake-off where a company is excited to go public. So then they go, hey, it's a beauty contest. Go find me all the top 10 bankers and you tell me how sexy I look. And the banker that tells them that they look the sexiest and they get the best valuation, that's the one that gets the deal, or that, or whoever has the best relationship with the insiders at a company. So then they fill out the super detailed form that talks about all the risks that the company has, including the risks that aren't really there in some cases. That's with the S1, but that is where you're going to get a lot of detail. That's where the bankers sort of legally have to go through everything, and that's great. That's where you get, that's really where the rubber meets the road in those S1s. Those are the sexy filings for those that really like digging through. Then you get the roadshow where they take these filings and they're sort of putting some lipstick on it and they talk to all these investors and they're trying to drum up business, seeing who would potentially be interested. But we'll see in a second why this is a really problematic process, because it then leads into a hand-picked price that is designed by the investment bankers and a hand-picked allocation. So humans are deciding what the price is and what allocation, these shares go to. So you're already limiting the number of shares that are going out, and you're saying, hey, this is going to be the price, and these are the people that are going to be getting it. As you could tell, like a red flag should be going off, like, oh, I think I see where the problem is. And based on these hand-picked ideas from the investment banker of price and allocation, you get this initial market-based opening, which is not market forces at all. It's dramatically supply-demand way off balance. So you get an Airbnb IPO that's 115% above its listing price, and you get that opening trading, which is just kooky dukes. So let's keep going. So a lot of this is taken from Bill Gurley. I gotta say, he is awesome for calling this out. He's been an advocate of saying, look, this IPO process is broken. We need to replace it with these two different options. We'll get into that in a second. He's a very successful venture capitalist who's railed against the traditional IPO process for some time, while also proposing these other successful alternatives. And here's what he has to say, where he's saying, the traditional IPO process does not use a market-based approach like an order matching system to efficiently match supply and demand and discover price. This is despite the fact that almost all the other financial assets are all priced sold this way. Matching supply-demand through an electronic system is exceptionally straightforward circa 2020. Most potential buyers of stocks are blocked out of the IPO process. Access is limited to the best clients of the investment bank. Most investors have little to no shot of getting an IPO allocation. So everyday investors, you and me, we have no chance of getting Airbnb at a fair price, C3AI at a fair price, Doordash at a fair price, because Wall Street insiders are gonna fleece you. and we'll get into that in a second. So it gets actually even worse. So the bankers, because they want to get their fees, they squeeze the system so much where it creates this crazy supply and demand imbalance, which leads to this crazy price action on the first and subsequent trading days. And here it is, Bill Gurley further, continues where he goes, for each one-on-one meeting you take, this is talking about management, the bankers talking with prospective investors. You are told you need 90% of the investors to effectively put in a buy order. They call this a 97% hit rate. Said another way, 97% of each and every investor you meet should have an interest in purchasing the offering. You are told the optimal target is to be 30 times oversubscribed. That's crazy. Like, how... This is your job as a banker to try to get an imbalance that's 30 times? That's nuts. I mean, this is not a joke. You are told that you actually need 30 times more orders than you actually plan to sell. This is an explicit admission that they plan to ignore 97% of the actual orders and fill only 3%. One huge side note here, most investors are blocked from even putting in an order, including the majority of all retail investors, i.e. everyday investors. Your chance is limited to 0. You're not going to get it. So the real oversupply is likely much, much higher than 30x, simply because most investors are not even given the opportunity to show their interest. The real oversupply might be over 100 times. Now, why are the bankers doing this? Now, part of it is they're underwriting a set price for the company. So, for Airbnb, they might say, oh yeah, we're willing to underwrite it at $68 and we'll effectively guarantee that you get the proceeds at $68 a share. So they're like, let's limit the supply and get the demand way up. So that way we can get this crazy high price. And we're going to handpick what's the right price. We're going to say, oh, you know what? Based on our feeling, we are confident we can underwrite at $68 because they get 30x supply. And they don't have the risk of potentially losing money. The bankers lower the risk of them underwriting a deal where they actually are backstopping a price where the price goes below the amount that they're willing to effectively underwrite. So like if let's say it was 1-to-1, supply demand, there might be the risk for the banker for them to say, oh yeah, 68, and then it trades below 68, and then the banker's like, oh geez, we might have to be the ones putting up the money for this. Like, this could be a problem. So that's part of the reason why. It's the bankers trying to protect their own skin. But this problem of creating, this dramatic imbalance is made even worse by lockup periods. And we'll get into that in a second, where here's the Airbnb lockup, which creates this crazy unfavorable game. And they talk about, we and all of our directors, executive officers, and certain other record holders that together represent approximately 80% of our outstanding Class A stock and securities, effectively are subject to lockup agreements with the underwriters or market standoff agreements until the latter of the second trading day immediately following our public release earnings for the second quarter following the most recent period financial statements, or the 121st day after the day. So you're talking about at least 121 days until the vast majority of shares are available. So like, they're pumping up this amazing pie for you to eat. And then they're like, oh yeah, only less than 20% of the pie is going to be available. You know what? And because we're going to screw around with the supply-demand imbalance, it's not even a slice of pie. It's like a slavette, as my Grammy Jammy likes to say. It's a slavette of pie. And that's what leads to this crazy imbalance, where prices are just completely out of whack. And even Warren Buffett has a take on the IPO process, he and his folksy ways. A lot of people like to diss him now that he's, hey, he's not keeping up with the latest SPAC, but you know what? I think he's probably worth listening to. So in 54 years, this was from actually a few years ago, I don't think Berkshire has ever bought a new issue, Buffett tells CNBC. The idea of saying the best place in the world I could put my money is something where all the selling incentives are there, commissions are higher, the animal spirits are rising, that's going to be better than 1,000 other things I could buy where there is no similar enthusiasm, just doesn't make any sense. So he's effectively saying, look, I'm aware of all these dynamics at play. I'm aware of this lockup period, which results in a short-term imbalance where supply is limited. I'm aware of this period where the demand they're artificially setting a price that's way below where it should be. That's resulting in this dramatic, price shock up. So he's saying, I'm aware of these dynamics. I'm cool holding off for things just to settle down. And that's why in his long career, he's never bought at the IPO. That said, one of Berkshire's lieutenants, Todd Combs, who Buffett has picked to succeed him, Todd Combs and Ted Weschler. So everyone that's saying Buffett did it, it's not true. It's Todd Combs did buy into the IPO of Snowflake, which at the listing price that Berkshire got was a fantastic deal, as it's subsequently up like 100%. So and it was a small amount. It was like a rounding error for Berkshire, like a couple $100 million versus, the $20 billion of free cash flow they're generating a year. So that needs to be understood. So you could say that Buffett's 54-year plus record, you could say, oh, it broke with this $200 million, IPO. I would say, look, the bigger lesson is recognize the game that's being played. Recognize when you see a game where the odds aren't going to be in your favor, or the odds, are being tilted in a certain way. You should be mindful of that in every game you play. And I want to play win-win games where I don't feel like I'm getting screwed. Is this the type of game where it's win-win, or is this a win, where the bankers win and maybe they don't care about the everyday investor? So who loses with this rigged system? And first of all, the companies lose. That's actually a big shock for a lot of people. So the companies lose out big time because the companies get the proceeds based on the listing price, not based on the trading price. And so here's an article from Bloomberg where Airbnb opened 115% above its initial public offering price. The biggest debut rally on record for a large U.S. listing. Had the share price closed to where they started trading at $146 instead of $68 a piece, Airbnb could have raised $4 billion more for the company and early investors. That's effectively that's malpractice, in my opinion. You might think Brian Chesky is a great CEO. This is malpractice. If you're running a company, you missed out on billions of dollars that could have shored up your balance sheet even more. So seeing this, and then here it is, they talked to Sequoia Capital, whose partner sits on the boards of both Airbnb and Doordash. If we knew where it would land, we would have potentially priced higher, but at the same time, we don't really focus on valuation so much. I call BS on that one. You know precisely what the valuation is. You know precisely where the valuation is when you invested in it. So to be like, oh yeah, valuation, schmaluation, ridiculous. Alfred Lin, a Sequoia Capital partner who sits on the boards of both Airbnb and Doordash, both companies that dramatically mispriced their IPOs, told Bloomberg Television about Airbnb. He said he's more focused on helping build Doordash and Airbnb into enduring companies. Okay, that's fine and well, but $4 billion more for a company's balance sheet helps create a more enduring company. That's 4 billion reasons why it's more enduring. So it's just ridiculous to have such a blind eye to such an obvious thing of this IPO process is broken. You need a better solution. And by the way, companies aren't the only losers. Everyday investors, they're the losers as well because they don't even get a chance to buy in until you get this crazy spike. So short-circuiting here. So, and that this is also the challenge here with impatient retail investors. They see this price action, the animal spirits start going, they think they're getting a great deal. Now, maybe long term, buying at a rigged IPO's price could be a good deal if the company executes in an amazing way, grows dramatically in the years ahead. That said, the odds are skewed against you. It's not a favorable proposition. The odds are skewed because you have that limited supply of shares with this lockup period where insiders can't sell shares for a couple of quarters, and it's artificially priced, which causes this demand spike. So who wins with this rigged approach? Like, who wins? And the bankers and their friends. Like, that's who wins. And the research shows from the Journal of Finance, there was a piece that was published that shows that there's, like, they can prove that there's a quid pro quo where the bankers allocate who gets the IPO based on who does the most commissions with the bank. And as someone, I used to work at a multi-billion-dollar hedge fund, I can vouch that is true. That is what happens. So if if you're a fund that does a lot of business with these banks, these underwriting banks, they'll be like, oh yeah, Airbnb at 68. Yeah, we think that's fair. Yeah, we think that's fair. We're going to allocate it to this fund that does a lot of business with us because I want to make sure I get my holiday bonus in time. So let's give this guy an extra helping of the Airbnb stock. And oh, I'm shocked. It opened up at $150 a share. Oh my goodness. Well, I guess that fund is going to have a nice bonus and they're going to have nice returns and maybe they'll send me a nice, bottle of wine and do some extra business with me through this year. So like that is how the game is rigged. The bankers, their friends, and then it gets even worse because you sort of get this incestuous environment where like the bankers are like, you know what? I helped out that hedge fund so much, maybe I can get a job offer from them, next year. And so it creates all sorts of mess. You help these funds by giving them an allocation of Airbnb at 68 or C3AI IPO at 35 opens up at like 90. Yeah. That's that's $35 a share, totally the fair price based on the supply demand we're seeing. Yeah, that's the hand-picked price. Yeah, that makes a lot of sense. And the fund makes a boatload, and the banker gets a lot of commissions. And you know what? Maybe next year he starts working at the fund. So what's the better option? So here is Bill Gurley. He's talking about direct listings as a better option, and that's where, and here he talks about when Spotify went public via direct listing in 2018, it marked the heroic 2-year work of Spotify's then CFO, Barry McCarthy, to bust open door number 2. The direct listing process is much simpler, is elegant, and uses modern market-based approaches to both price discovery and allocation. It is not overly complicated or sophisticated. I would argue, I love this part, that any first-year finance student or computer science student would naturally assume this is how traditional public offerings already work. They would be wrong. You are using a standard order matching system to match supply and demand, as opposed to having the balance off by 50x. So the direct listing avoids 2 fatal flaws of the traditional IPO process. It uses a market-based approach to matching supply and demand and discovering price. Precisely, it uses an order matching system following the price time algorithm. Anyone with a brokerage account, i.e. any everyday investor, including platforms like E-Trade, Schwab, or Robinhood, is invited to and able to participate, put in an order. It is open to all. So how does it work? It is actually much simpler than a traditional IPO. You just remove the 2 steps where the shares are intentionally underpriced and then given to the investment bank's best clients. You still have the bake-off to pick an advisor and you still prepare an S1. You also do a presentation to investors that are typically online and more detailed than an IPO, but then you jump straight to the market-based match. Boom, mic drop. So in summary, here's the traditional IPO process where you have these 2 extra steps that create a lot of problems, that effectively fleece everyday investors, that fleece the companies that are doing it at the tune of billions of dollars. And it's because they're selecting a hand-picked price and a hand-picked allocation. The companies do this with the trade-off of saying, hey, we're effectively guaranteeing that set price of proceeds that we're going to get. Oh, it's Airbnb at $68 a share versus the $150 that they could have gotten. Let's say blended. Maybe blended, it would have been $100. Whereas a direct listing, very similar process, bake-off, S1, roadshow, direct listing. Let's see what the supply demand looks like. Then it starts trading. No hand-picked process here. So in summary, the difference between the IPO and direct listing is an unfavorable setup. I am not saying that I would avoid all IPOs. I'm just saying that probabilistically, from an odds perspective, the deck is skewed against you. It's not as favorable as I would like, especially when you factor in all these aspects that I already mentioned. A lot of aspects going against you. Is there a third option to consider? Yes, there is. And that's SPACs. That's the reverse merger where you have a pile of cash, usually trading around $10 a share, where management is incentivized to find a company, a private company, that they bring public through their SPAC. And here's a picture of the SPAC king himself, Chamath Palihapitiya, where he's registered the IPOs, IPO-A through IPO-Z. He's already done a few. I've done videos, I think, on all the SPACs actually almost all the SPACs that he's done. I'll have a note below in the comments where you can see all the videos I've done that cover this, like Clover, Open Door, MP, Materials, Desktop Metals. You can see the full alphabetical list. But the advantage of the SPAC is that it does make it a much cleaner process, because whoever the sponsor is, they set the deal, and there's this give and take of like, what's the fair valuation? Then they announce it to Wall Street, and immediately investors can start pricing in, like, oh, this is the data that, like, based on management's presentation, these are the pros and cons of the company, and do I think this deal will go through? Does this, what's this valuation imply? The challenge with SPACs, however, is that you can skew the information dramatically in such a way that you come across as better than you are, at least at first. And one of my most recent videos talks about a stock that I actually invested in that is a SPAC that went up, like 40% within a few months, where I thought their presentation versus their S1 filings were quite misleading, where in their presentation they showed what was a really diversified customer base, whereas when you actually went through the detailed financials, it appears that they had revenue, so here it is, presentation, diversified customer base, detailed financials that are legally, structured, show that, like 80% of their revenue comes from two parties. Very different way you can paint it, and partly that's because when you're putting together a presentation for a SPAC, the rules are a lot more flexible. So I would say with SPACs, there's a lot greater chance that you're bringing something that isn't as attractive to market, but you get this initial hype, and people are like, yes, let me buy this. It's a lot of lipstick, and the lipstick looks good, even on a pig. So what Chamath is doing, I applaud it, because it's certainly interesting, and it's a great way to bring a lot of companies to public without this skewed. I would certainly prefer a SPAC process versus the traditional IPO. Absolutely, every day of the week. That said, there are some downsides to SPACs, as you can be bringing up. It effectively depends on the due diligence of the sponsor, and there's a good chance that you're bringing effectively crappy companies public. So if you're looking to avoid these types of rigged games, though, with the traditional IPO process, or just rigged games in general, where the odds are sort of skewed against you, and you want to find quality companies or even unrivaled companies that can potentially compound for years at a time, I think you know what I'm going to say. You need to go to unrivaledinvesting.com, click on Journey. I will post my December multi-bagger pick this weekend. That's the plan. And at unrivaledinvesting.com, you click on Journey. I have a lot of exclusive content about individual videos, a potential multi-bagger each month that I call out for Journey subscribers, an educational series to help you improve your financial journey, a monthly update about what I'm buying, selling, and holding. You can see the full catalog of content below. I'll put it in a link below. And the reality is, just finding one potential multi-bagger can change your life journey. So if you're interested in following my journey to try to find these multi-baggers, go to unrivaledinvesting.com, click on Journey. And if you enjoyed this video, learning about how the IPO process is a rigged system, oh my goodness gracious, if you enjoyed it, make sure you subscribe. If you're already a subscriber, I appreciate that thumbs up, and thank you so much for watching.